Hi everyone, I'm Chad Shoop and welcome to your latest edition of Bank It or Tank It. Today, I'm going to be covering a hot stock, Sony, that's been kind of on the sidelines lately because they haven't been able to get these PlayStation 5s out the door. All sorts of disruptions. In hindsight, they're just way behind the curve. These should have been out back in Christmas. Here we are in May, coming into the summer months, and PlayStation 5 still aren't on the table. I'm going to talk about why that's important for Sony today and what it means for the stock coming up in this Bank It or Tank It. And remember, our Bank It or Tank It's each video, the sole purpose of whether or not we want to bank on this stock going higher or is the stock that's going to tank and head lower over the next several months. So today we're going to end that on Sony and let you know what to expect from this stock. But I just want to remind everyone that these stocks are companies that you all recommended, that you all send, that you leave me a comment on, that you send me an email about. So just keep those comments coming in. Let me know what stocks you want me to feature in an upcoming Bank It or Tank It video. I'll be pulling together a new quick takes video in the next week or so where we run through 5 stocks in just 5 minutes just to give you the quick highlights for the stock and what to expect. And I do it the only way I know how, and that's on a price chart. So you're going to see how I like to break down a stock quickly on a price chart to figure out whether or not this is a stock I want to bank or tank over the next few months. So let's dive into our video today on Sony. Now, Gabriel recommended this stock a while back for me to take a look at and figure out, put it on my radar and let you know. Now, I mentioned the PlayStation 5 and why it's important. So let me pull up this chart here of the segments and break down Sony so you can see how big of a deal these PlayStation 5 delays are for the stock. So here's the game and network segment. This is where PlayStation 5 lives. Their gaming, their console, and it's at the heart of their devices. And it's 28.9% of their total sales. That's a massive amount. You can see no other segment gets up that quite that high. Their electronics production products and solutions, that one's 20%, and that's another consumer-driven product, talking about their TVs, their smartphones, and cameras. That ended up being in there, and they also have a music, pictures, financial services. That's ended up being a pretty large department as well. And we also know that they produce movies, so they have a lot going on in Sony, and it's a very unique stock for that purpose. But again, game and network services, almost a third of the revenues come from this product line, and it's PlayStation 5, and that was the huge development here in 2021, actually 2020, when they rolled out this new platform. They only come out once every 4 or 5 years, so it's not a common upgrade, and it's a big deal because it makes up nearly a third of their revenue. So this has got to be on their radar, and it's on investors' radar. And when you take a look at the chart, you'll see that in a moment. In hindsight, it might actually be the best thing for the company because what they're doing now is moving out older inventory, the PlayStation 4s, all the hardware for that, all the video games and consoles and controllers and just all the devices that go for the PlayStation 4. They've been able to move like crazy because we've been in a pandemic, so people have been buying this stuff up in insane amounts over the last 12 months with stimulus checks, with just sitting at home a lot more. People wanted the best gaming devices that are out there, and Sony had it, and Microsoft's one of their key competitors in this compartment. They haven't been able to get out their new state-of-the-art gaming consoles. So as those begin to roll out, I think it's just going to pad the bottom line of a company like Sony and Microsoft. So that's going to be one bullish indicator to keep in the back of your mind when we take a look at the stock today. So now I always like to start with the key stats. And for this, I pull up a quick chart here of the revenues, which are the blue bars on the chart, and the key for that's on the right-hand side. And then the net income, which is on the line on the chart, and the key for that's on the left-hand side. So you can see that their net income is steadily rising, even in the expectations. They're getting a bump here in 2021 for the last 12 months. And that's, again, that's the pandemic-related boost where people are just buying up all of their older products that probably weren't even going to see, sales for years to come. They would have to experience massive markdowns, and instead they were able to get top dollar for these things by putting them out in the market in this crazy environment that we've been in. So that's going to pad the bottom line like you're seeing there, and then they have it dropping off with a steady decline. But revenues are just steadily going up, and that's what you love to see. And sometimes I would take this with a grain of salt, but when you can look back over the last 3 or 4 years here, you see that their revenues are pretty consistent, going higher. They had a dip in 2020, but now even with headwinds from production disruptions due to pandemics, due to chip shortages, all these other issues, they're still expected to post decent revenue numbers, a nice jump from where they were a year ago, and they climb steadily from that. So this is totally realistic, and it's a great view to see for the stock. Now let's take a look at the quick comps and see how Sony stacks up. You'll notice a lot of these companies are not American. They're all listed in the Tokyo Stock Exchange, except for LG Electronics, Korean, and that's because of the TVs aspect. Again, we just looked at the segment breakdown. They're all over the place here. They have cameras which is Nikon Corporation. Their competitors there, they have TVs, LG, Sharp, Panasonic. Microsoft's on a whole different path. They have all sorts of things as well, including the Xbox, but then they have more of the laptops and other devices for the consumer. But the grand scheme of things, these are the list that comes up on the quick comps through S&P Capital IQ. So we'll focus on that today. You can see the market cap for Sony, almost 120 billion, so it's pretty massive. The average of the rest of these is just 17 billion, so these are pretty small cap stocks. Nintendo's a $66 billion company, and that's just strictly video gaming. So that's a key competitor to keep an eye on as we take a look at this. You can see their sales over the last 3 years have been enormous, and that's partly due to the Switch. They've been able to really rebrand with that, and that's because they were struggling for so long. So Sony's sales are only 1.8%, the compound average growth rate over the last 3 years, and that's because they've been a lot more consistent. We saw it on the key stats. They're a consistent company. Nothing wrong with that, but they're just not in that all-out growth mode. And then for the net income, we can see that 33% growth on net income. That's a solid jump in net income, and that's consistent over a 3-year period. So they've been focusing on padding the bottom line, boosting profits, even with slower sales. So their sales are not taking off like crazy, but they've been able to do a lot on the bottom line. Now let's take a look at the sentiment and just get an idea of how investors feel about these stocks. You can see that Sony's priced at only 11.2 times earnings. That's really, really small. The average for the S&P 500 right now is at 39. So that's a really high PE. You can see the mean here is 38. So it's in line with kind of what we're seeing with the market. But Sony, just 11.2 times earnings. That's very, very cheap in the grand scheme of things when you look at just what they're being charged or paid on earnings. And then when we looked at their net income, the earnings, the bottom line is still expected to grow. So this is not a fluke. This company is just not being valued for growth right now, and it's showing on its price to earnings ratio. Short interest, since these are listed in Tokyo, we're not showing up the short interest that we would usually talk about here. But then we have the average broker recommendation, a 1 being a strong buy, a 5 being a strong sell, and Sony sits at 1.62. So it's an outperform rating. It's very solid, and the average here is just 2.53, so right in the middle. It's basically slightly better than a hold, and the companies are all over the place. But when we look at Nintendo, a key competitor, they're 1.84, so another strong buy in the gaming compartment. Then TVs are up and down. We have a 4 for Sharp. They're not loving that one. But then Panasonic, LG, they're kind of bullish on those companies. But Sony is the key one today that we're looking at, 1.62, outperform. So it's got a pretty bullish rating from the analyst community at this point. Now, last but not least, my favorite part, the technicals, the price chart. We're going to dive into Sony and see what you can expect from this stock. And there's just a few key things I want to point out here. The first has our key trend lines. We have the red resistance sloping down at the top, and then almost a horizontal green support line on the chart. That's creating basically what's going to be called a descending triangle pattern, where we have a falling resistance and a sideways support line. But you can see that this is a wide channel, so Sony has got plenty of room to bounce around in this before we see a breakout. But the great thing that I love about triangle patterns is that we use them to get an expected move for a stock. They also tend to be bullish patterns or continuation patterns, which continuation means that it plans on heading the path that it was before. And you can see on the left hand side of the chart, Sony's price was lower than where it is today, so for it to continue, it would be heading higher. So we're expecting this to break out to the upside. That's going to help it be on my bank it list for today, but that breakout could have come at any point. And when it does, though, we can take the height of the pattern, which is about $20 per share, and add that to the breakout point. So if it breaks out at about $105 a share, 106 here a few weeks down the road, then we're looking at about a 30% rise in the stock over the next few months. So my price target on this, I'm going to put it at 135 over the next 12 months. That's about a 45% rally from where the stock is currently trading. But what we're looking at really is this triangle pattern and a breakout. You can see that I highlight the candlesticks on the chart and the colors of the relative rotation graph just to let me know where it's at relative to the rest of the market. And green shaded candlesticks means it's leading, yellow means it's weakening, red is lagging, and blue is improving. And you see a rotation that just continues to go back through this. So right now it's red, so this Sony is lagging the market right now, and what we'd expect to see next is that it would start to improve, which would be the blue candlesticks, and that should help lift it a little bit from there. And then if it gets back to leading, then that could push it back up to this key resistance line in red. And from a way to trade this, because you don't want to try to pick the bottom, because they could break out to the downside. That's always a risk factor. But you can take a look at it this way. If it's above 100, which gives you a little bit of a cushion, between the downside support that is going to act as a key level to watch. If it's above 100, then you want to buy the stock. You want to buy it and bet on it going higher and try to ride and time that breakout that we're going to see the stock run up to $120, $130 a share. But if it falls below $100, use that as an opportunity to exit the stock and see if it breaks down lower. You don't want to be caught in a plunge below the screen support line because it could fall much, much further if it breaks below that. You see that it wasn't even a year ago that this was trading in the 70s. So it could go through a 30% plunge just as quickly as it could go through a 30% pop. So that's all for my bank it or tank it today. Sony's definitely a bank it stock. This is a stock that's going to head higher. Over the next few months, we have a price target of $135 a share. Nice rally from where we're sitting at today, and we just want to keep an eye on those key trend lines on the chart to let us know what to expect. But the main thing we're looking at here is that we have pent-up demand for the PlayStation 5. That's going to help boost revenues, and that's going to help boost the bottom line. So those are the key things that I'm looking at that make me want to own Sony here, especially above $100 a share. Buy it, trade it on the short term through this little descending triangle pattern, and watch for a breakout in the coming weeks. That's all for today. Till next time, I'm Chad Shoop.